From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for October 20th, 2023. Checking the calendar, your Milwaukee Bucks close out the preseason tonight at the Forum with the Memphis Grizzlies. And the regular season opener is Thursday in Philadelphia. And the Packers finally have a Sunday afternoon game. They're in Denver for a 3:30 start. It's also this Sunday is the second annual Fall Food Truck Frenzy, 11 to 3 at Retner Park in St. Francis. Don't worry, you'll be home in time for the kickoff. Okay, here we go. Amish men are being shunned after the recent nationwide emergency alert because these guys didn't mute their phones. The alert outed them for having cell phones in the first place. They're not supposed to have them. Oh, they're in big trouble. Russian officials held a grand reopening ceremony for a bridge in the Belgrade region, but it turns out the bridge was stolen from a neighboring village. Apparently, all countries bordering on Russia can't have nice things. A Canadian man was arrested Monday for calling the cops 25 times to help him look for his lost hoodie. He wanted the cops to drive him around town looking for it. I think there might also be a meth charge waiting for him when he gets back. And finally, here's a different kind of drug story. A 77-year-old Florida man is facing prison for running what can only be described as a black market for erectile dysfunction drugs. He was 77. He was found in possession of $1,800 worth of little blue pills. He must be the most popular guy at the Villages. On the podcast today, we have Art Rothschild, Tom Pappenfus, Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. I think we all want to know if he found that sweatshirt or not. A rough week overall for markets, a lot less to laugh about. The NASDAQ down 3.2%, closing at the bell at 12,984. The S&P 500 down 2.4%. That's down 104 points this week to close at 4224. The Dow Jones Industrial Average held up a little better. The less growth-oriented, less tech-heavy stocks doing a little better this week, down just 1.6%, down 544 points after losing 288 points on Friday to close at the bell at 33,126 for the year. The NASDAQ still up a stellar 24.9%, including dividends. The S&P up 11.4%. And the Dow Jones Industrial Average slightly positive at 1.6%, although if you strip out the dividend return to the Dow Jones, the Dow now back in negative territory for the year. You know, I think, Art, the big story this week was the move in Treasury rates, and in particular the 10-year Treasury. After finishing the week last week at 4.63%, we flirted at points in time on Thursday and even early Friday morning with almost 5%. It's been a long time since we've seen 5% on the 10-year Treasury, and maybe that number making investors a little bit nervous.
Yeah, but it's sort of kind of bringing joy to the Fed because it means they don't have to work as hard to slow the economy because these higher interest rates at the long end are definitely doing it. They're making mortgages more expensive. They're bringing down the stock market, which is a good thing as far as the Fed is concerned because it'll dampen enthusiasm for being more aggressive, in your stock picking. So the fact that we're back to where we were in 2007, the fact that it happened so quickly this week, or has happened so quickly over the past couple of months, really isn't disappointing me because, quite frankly, it's returning to a more normal relationship between the short and the long-term yields. We've had an inverted yield curve now for a couple of years with this anticipation of the Fed having to lower rates. Now the question is, when are they going to do that? They're suggesting it won't happen until maybe late next year, at the earliest. So investors have to expect some volatility in treasuries, not just stocks. So the further out you go, the more risk you're taking. The fact that this happened so suddenly, I don't think we can put a finger on why in particular, but I don't think it's necessarily a bad thing for investors to have a sense of concern about what's happening, but not to be terribly disappointed. This is just normal, ups and downs of bonds as well as stocks.
Yeah, I think it's just kind of alarming at first. It's not so much the level, because to your point, going back to 2007 and looking back at a longer term time frame, I think the average 10-year Treasury has been about 5.9%. So, I mean, at different points in time in the past, hasn't been a death knell for stocks or other asset investments for growth. So I think it's just alarming because it's a shock coming off the backs of 13 years of very low to no, very low 10-year treasuries, and ultimately what does it mean? And so we're still trying to, I think the markets and just the general investors trying to figure that out. What does it mean? And obviously it's rattling things and creating more volatility, more concerns. But I think we just need to let the dust settle. Like you said, I think our main concern, I think the market's main concern right now is just what is this maybe more terminal level of interest rates, and what does that mean for stocks? What types of stocks may do better in this kind of environment? And we're still waiting to see that. And part of this move, this market induced rate is kind of doing some of the work. It's going to start to see the slowing. We haven't seen it yet, but I think that's what is remaining to be seen.
So we enter a Fed blackout period where at least 10 days prior to the Fed announcement in early November, we won't hear really anything more from Jay Powell, from other voting Fed members, and probably a good time. They had a lot to say this week. Jay Powell mentioning that maybe the higher 10-year Treasury rate is doing some of the Fed's work, certainly a reflection of high for longer, if not higher for longer, that the Fed has been talking about. And, of course, a lot behind maybe why the 10 years moved as much as it has. What's interesting to me this last week is that the short-term bonds haven't moved at all. The expectation for rate hikes through the end of this year is basically, there's a small chance we get one in December, but not all that likely when you look at what the market believes. Jay Powell did his best to say, no, inflation's still the problem and we're still going to fight it, and yet again, I don't think the market's buying that there's much more on the short end of the curve. And so you see this large move this week. We moved 30 basis points higher on the 10-year, and yet the 13-week, the kind of short-term measure of Treasury bonds, moved lower this week. An expectation that at least for a little while longer, there's not all that much likelihood that rates move higher. And some of this is very technical. When you look at the Fed unwinding a balance sheet that was on the order of trillions of dollars in Treasury debt, well, if they're now letting Treasuries mature off the portfolio rather than buy, there's fewer buyers. And so, Tom, one of the things you mentioned kind of before the show was there's a lot of technical things driving a higher 10-year Treasury. Some of that's potentially just less demand overall.
Yeah, I mean, it comes down to a supply versus demand issue. If we have especially as we need to meet, as we see kind of our balance sheet and a lot more debt out there, and as we possibly are looking at higher rates to pay down that debt, we need to issue more to pay on those. And what happens is ultimately, in order to issue that, you have to have a buyer for that. But if there's limited number of buyers, you're going to have to make it more attractive for them to buy it. So the challenge can be that we may not see yields drop dramatically quickly because of that need for new buyers to come in and them, again, demanding higher yields. It could keep rates a little bit more elevated for longer.
And of course, you've got countries like Japan and China less interested in our debt, in addition to the Fed buying less of the Treasury bonds that are out there. And so, maybe some signs that the borrowing itself is supported at 5 instead of the 4 that it was a while ago. You add in that, well, we may need the yield curve to normalize if growth really is as strong as we've seen. And that tells you that there's a pretty natural cap on how high rates go, but also a pretty natural cap on how far they fall from here, at least in the short term. And so I think there's this kind of expectation that maybe we're trading in a more narrow range from here for the 10-year, for bonds more broadly, if only because the range of expectations is a little tighter.
But the good news is that and you've talked about this on the show repeatedly, bonds are a better investment than they have been in decades. And so because you can get 5% or close to 5%, not to mention short-term bonds and CDs and money markets paying 5%. So this is a great opportunity for people to have safe money, get paid on it, higher than the rate of inflation. The Fed, to a certain extent is, again, exacerbating the problem by releasing bonds, number one. And so they're adding to, they're probably happy that rates are going up because, as we said, it is doing their work for them. So again, I'm not alarmed by this. It's just a question as to why it took so long. But furthermore, when they do lower rates eventually, so it's taken these higher rates to finally give us a sense that maybe things will start to slow. So at that point, if the Fed lowers rates, maybe that will contribute to a more normal yield curve, which could suggest that, a more normal economy. But I don't know if we're there yet. I don't know if we'll know until we get there.
Yeah, we are still dealing with the impact of COVID. We're still dealing with the reworkings of supply chains that are, 3 years in the running now. And so a more normal economy, I'm not even sure we know what that looks
Exactly.
like. We talk about what's the long-term average. Tom, you mentioned 5.9% on the 10-year Treasury. Is that the right number? I don't even know that we've got a good sense of what that should look like beyond where we are today, just given how quickly things have shifted. And so what's interesting is in the midst of all of this Treasury talk this week, we had a number of earnings reports come out. Tom, we had banks, we had some consumer stocks, some signs that earnings are getting better, but still pieces that we need to watch out for.
Yeah, we're still, looks like we're, as far as earnings releases this week, it looks like we're still beating the average. I think we're about 81% or above their earnings forecast for the week. Against a long-term average of about 77%. So obviously it hasn't moved markets, the positive signs in that way, because they're just not concerned about it. I think rates are still the number one issue facing. And not only that, but paying attention to, some slowing, potentially, a strong economy, but underneath the surface, maybe forecasting slowing down the road and how that might impact our earnings, looking out 12 months down the road.
And I think one of the things I've kept a close eye on in the earnings reports is how consumer cyclical companies, how banks, how some of the credit card companies are talking about the consumer, and some signs that maybe they're a little more concerned now about some spending that's already taken place on revolving debt, some write-downs that are taking place on some of the smaller banks to protect themselves from potential losses down the road. And then, most importantly, maybe some signs that some of that high-flying spending that was out there has started to taper off in some areas. I don't think a quarter tells us all that much, and that's always part of the problem with earnings season is we're getting a very small snippet in time. We're getting 3 months that are, very unique to the rest of the market. But what's maybe most important right now is that at least the way earnings are shaping up, we may finally be back to earnings growth. We've talked about recession at length and how likely is it the economy enters recession. Well, a reminder that corporate America, from an earnings standpoint, has been in recession for the better part of the last 3 quarters. This third quarter here in 2023, finally back to growth, hopefully, and a little bit stronger growth as we look ahead. Forget for a second that probably doesn't come without 7 names, right? We're talking about that Magnificent 7 being the thing that's really driven the earnings growth. Absent that, you're talking about an earnings outlook that's a little more bleak than what we've already seen. So I think we can't forget, in the midst of all this conversation on macro topics, on kind of the economy more broadly, we can't forget that it really is about earnings and interest rates. There's a reason why those are the first 2 things we talk about today is, well, we're in the middle of earnings season, and the 10-year Treasury had a pretty massive move. Interest rates had a pretty massive move higher. No wonder that's what we're talking about. And yet, the geopolitical risks seem to keep piling on. No shortage of things to distract investors from the bigger picture.
Yeah, it's pretty strange, quite frankly. Normally, in times of crisis, people buy treasuries, so interest rates go down. That's not happening this time. People are selling treasuries, and interest rates are going up. Selling stocks, that makes sense. When you've got a crisis, reducing risk, the fact that the NASDAQ went down more this week than the Dow, that's a normal pattern. But the fact that the S&P is still up 10% or whatever for the year, well, it's disappointing it was up 20. If we were timing the markets, which we don't do, which we don't endorse or embrace or think is, something you can do successfully, would have been nice to have sold, at the end of August, take your money and run. I think you guys might have mentioned that on the show at one point, not suggesting it, but we had a good year going, but we don't have a bad year, all things considered. And when you consider, the magnitude of the global worries, war in Ukraine, now we have a war in the Middle East. Now we have our Congress in gridlock because the House can't, get a speaker. And the stock market just went down a little bit this week. We're down a bit off the highs. That tells you how strong the potential is for the future, And not to mention the fact that the U.S. economy is probably the best in the world at this point. China's economy is slowing. Our economy is likely to grow faster this quarter. The numbers we're seeing forecasts of 4% to 5% growth. In the third quarter just ended, and as you suggest, corporate profits are going to start reflecting higher earnings next year. Let's just hope we make some money. But this week, what do you expect with all the negativity out there? We're going to lose a few bucks every once in a while.
Joel, Art mentioned the kind of growth rate here, expectations for the third quarter, but some news from the Conference Board on leading economic indicators that, they're at least seeing the potential for maybe a little slowdown as we enter 2024.
Yeah, Kyle. So that business research group is one that takes 10 different broader indicators and has studied them, up and down for years. And based on those indicators, they can make forecasts on what's going on with the bigger economy. And what they found in what they released this week was that their indicators have been down for 18 months in a row. And throughout that time, they've been saying, well, a recession is coming, And now they're saying, actually the alarm bells aren't ringing anymore, but we're still forecasting that there's going to be what they called a shallow recession in the beginning of, in the first half of 2024. They actually measured how much their indicators have been going down, and the pace of contraction slowed down the last 6 months versus the 6 months before that. But they're still seeing signs that it's not going to get better and that there is going to be a recession.
And perhaps there's something to be said for some of the comments from late last year into early this year about a recession coming, but coming in a much more atypical fashion, right? A more of a rolling recession than a static recession, seeing it in different parts of the economy at different times, even in different regions at different times. And so maybe that's more of what we're seeing now is it's not that they were wrong. Yeah, the sky did fall. It's just not where I'm standing.
And it's got to make it that much harder for the Fed governors to decide what to do about interest rates, because they're raising those rates to cool down inflation and to try to do it without plunging us into recession. And as we talk about at the seminar, which is going to be on our website now, so if you go to Landaas.com, you can access the video that Jason Scuglik put together of the Investment Outlook seminar. But as we said in that, is that there's a lag between these actions that the Fed takes and the effects on the economy.
Other economic data, we had retail sales data, maybe a bit of a mixed bag there.
Yeah, mixed bag is kind of what we talk about every week. And again, that makes it harder for the Fed. It'd be different if all the indicators were going down or all of them were going up. But the retail sales numbers show that consumers are still spending. They're spending on different things, though. They're, 10 out of the 13 major categories were actually up in September. The things that went down were things like appliance stores and clothing stores, home and garden centers. The things that went up the most were car dealers, online retailers. And then, one that we kind of look at closely month to month is the bars and restaurants. And that went up again in September. And it's usually a sign that people are still confident of going out there and spending some money.
And potentially that appliance number and the home and garden number maybe tells a story of a housing market that's been a bit challenged recently. You don't have a new house. You don't have work you want to do on that new house, or if you're so encumbered by that higher interest rate, potentially you don't have the money to spend on those new appliances and that new gardening. Of course, we got some housing data this week too that, to abuse it, maybe also a bit of a mixed bag there.
Yeah, the National Association of Realtors said that existing home sales were at the lowest pace since 2010. So that's a doozy. It's 15% behind where it was a year ago. Then we also had new housing stuff that's being built. The Commerce Department reported on housing starts and building permits. Those are both 25% down from where they were in the spring of 2022 when the Fed started raising interest rates. So those, first of all, that affects mortgage rates, right? And so we've seen those numbers going down. They're now below where they were before the pandemic.
And then I think, a somewhat light week for indicators, but every one of them seems to carry a lot of weight. We had unemployment claims come in maybe a little better than we've seen, or better than we had hoped for.
Yeah, there's another, you talk about the mixed bag. I mean, that's one that week after week we see that the labor economy is still pretty robust. I mean, that initial claims for unemployment insurance is a sign of how reluctant employers are to let go of their workers, and they're pretty reluctant.
Yeah, as they should be. There's plenty of opportunity out there right now. There's plenty of for hire signs still up everywhere you look. And so I think as we kind of look at an economy that continues to potentially soften a little, well, we've got plenty of room for that softening, plenty of opportunity going forward. If you're interested in checking out that video, as Joel mentioned, it'll be on the website soon, available to access. And then most importantly, ask questions, right? As you're going through it, feel free to reach out to your advisor. Feel free to reach out to your team more broadly, just to figure out, okay, here's what this means for me. Because it's one thing for us to paint that picture in kind of broad strokes. It's another to know, what's this mean for me specifically.
Watch it closely, though, because we'll post another quiz in a couple of weeks, and so you'll want to test your knowledge.
Yeah, extra credit if you need it for your class grade here. We enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.